Welcome to ForexTV.com. Today's Tuesday, March 17th. Happy St. Patrick's Day. I'm Tim Kelly with your New York Forex Market Buzz. U.S. dollar is mixed against most major currencies as the U.S. equity markets returns to positive gains at midday. Crude oil is up and gold is down. And now for a look at the latest headlines from the CEP news desk. U.S. housing starts surprise to the upside. U.S. core PPI rises more than expected in February, and Canadian labor productivity unexpectedly falls. Housing starts unexpectedly rebound led by multifamily starts. The U.S. housing sector showed unexpected strength in February, with housing starts and building permits both rising against expectations for continued declines. U.S. housing starts rose to an annualized pace of 583,000, representing a month-over-month increase of 22.2%, that according to the Department of Commerce. The consensus was looking for starts to decline to 450,000. The previous month's reading was revised up to 477,000 from 466,000. Meanwhile, building permits rose to 547,000 in February, up from 531,000 in January. The consensus was looking for a decline to 500,000 building permits. U.S. core producer prices rise more than forecasts. U.S. core producer prices climbed slightly more than expected in February, that according to the U.S. Department of Labor. Ex-energy and food PPI grew by 0.2% monthly, following a 0.4% jump in January. Economists had expected a 0.1% increase. On an annual basis, core PPI was up 4% against a prior 4.2% increase, and a headline PPI was down 1.3% from 1 year ago against a 1% drop the prior month. Headline PPI grew 0.1% month over month against expectations for a 0.4% jump and following the 0.8% gain in January. The FDIC accepts limited extension of debt guarantees. The FDIC has approved an interim rule that extends debt guarantees. It is effective immediately, and fees will rise 10 to 20 basis points between April 1st and June 30th. Two key U.S. weekly retail reports show spending down. The ICSC Goldman Sachs survey reported that chain stores sales fell by an annual pace of 1.4% compared to a previous week's 0.9% contraction. On a weekly basis, sales fell 0.1%, partially reversing the previous week's 0.2% increase. The news was in line with the Johnson Redbook retail survey, which recorded a 1.1% decline in the week compared to the same period last year. Sales to date in March were largely unchanged compared to February. Today, we're joined by Matt Esteve, a foreign exchange trader at Tempus Consulting. Matt, thanks for joining us today on the program.
Thanks for having me.
Happy St. Patrick's Day.
Happy St. Patrick's Day to you too.
Matt, we talked a little bit before this interview about a little bit of a surprise in dollar weakness. Coming out of last week, there were a lot of expectations dollar would continue with strength. Right now, we have gold off and continuing to fall. Crude up slightly, and U.S. equity markets doing quite well, extending last week's gains. Is this equities driven, this dollar weakness?
Yeah, I think it definitely is. What I think we're seeing here is that as equities push higher, and although they were negative a few points yesterday, this is almost a week-long rally now in equity markets, and so the dollar's bid as a safe haven instrument has abated as of late, and so that's why you've seen the dollar weaken against the euro and weaken against the sterling, specifically in the past 24 to 48 hours.
Right. Now let's talk specifically. Euros seems to be holding that 130 level.
Sure.
What do you see in the next week and weeks ahead for euro?
Right. I think the dollar, as equities do push a little bit higher here, and hopefully they will continue their gains. I think you could see euro dollar push upwards towards the 132 level. But really, I think the dollar's downside is limited by the fact that investors remain confident that the U.S. economy is better off than the European economy, and later this year will be better set for a recovery compared to the eurozone.
You know, we had some, the ZEW survey out of Germany was better than expected. Speaking of the euro, is that just an aberration, you think, or do you buy into it that we're improving here? And some better signs in housing in the U.S. as well, for that matter.
Absolutely, absolutely. And while no single piece of data can be a signal of necessarily the complete turnaround here. So just because we had better housing starts today than what was expected, that doesn't mean that the housing market has rebounded. But what it is a nice glimmer, a hint that there is a light at the end of the tunnel here. And with the U.S. Federal Reserve and the U.S. Treasury having been as proactive as they have been over the past 6 months here, the U.S. economy, I think, is still on track for a recovery later this year. And while the Eurozone economy will follow suit, it'll be a much slower and a much longer recovery, considering the Eurozone officials have been much more reticent to act.
Well, that's a good point. President Obama is trying to allay any fears of a rift between the U.S. and Eurozone policy in terms of stimulus. Obviously,
right.
There are differing opinions there, but it does, by outward appearances right now, look like the U.S. stimulus activity is having some, at least short-term, desired results. Do you think that Eurozone and ECB and the rest of the folks there are going to have to follow suit at this point?
Well, it's. Obviously the Obama administration and the precedent that they've set now with, really extraordinary actions, both monetary policy as well as fiscal policy. I think the ECB is probably looking from the sidelines, scratching their head as to why they didn't do the same several months ago. At this point, they might, they're obviously, the ship has sort of sailed here, and so they're not obviously behind the ball, and they're delayed. And so even if they were to enact a similar type of stimulus program, I'm not sure what type of effects it would obviously have in the near term as well as the long term.
Okay, so let's move on. Sterling. Sure. Sterling has been very, very volatile right now. Gyrations both ways. It's a two-way market there in the last 48, 72 hours perhaps. But can you give us some thoughts on sterling?
Sure. Sterling is always going to be a bit more volatile, and while British interest rates are obviously low, it's going to be extremely susceptible to any type of interest rate implications. And by that I mean that you have the Bank of England now actively purchasing government debt. And so with the Bank of England expanding their balance sheet on a massive scale, that adds up to sterling weakness in the long term. And so at the time being, we're seeing this 140 level as a pivot point here, but obviously there is no fundamental reason to have a strong sterling in the medium or long term.
Okay. Matt, I'm going to keep it moving along here. Yen seems to be struggling to get to that psychological 100 level. Some talk about intervention at the Bank of Japan. With yen weakening, is that really in the cards? There's a lot of talk about that because of the Swiss National Bank and what happened with the Swiss franc. Do you think it's a possibility that we might see some intervention? And if not, when do we breach that 100 mark and go above?
Right. Well, we have to remember with the yen is a little bit of a different situation here in March, that it's the end of the fiscal year in Japan at the end of this month. And so with that, a lot of Japanese companies will repatriate funds into Japanese yen to sort of window dress their balance sheets. And so the yen, its downside has to be capped at 100 right now. But after this month, I think we could see a dollar breakout on yen, and I think we definitely will push back above 100. Specifically with the Bank of Japan becoming a bit more proactive here in combating their country's recession, and actively providing liquidity to the banks of Japan.
Okay. This end of the fiscal year is always an interesting time for you.
Right. Right. So I think the yen's resistance at 100 here is a bit artificial. And I think after March 31st passes, I think we will see the dollar push above 100 on a yen.
So wait and see for yen traders at this point.
Yes.
Matt, let's talk briefly about some of the commodity currencies, Aussie
Sure.
and Canada.
Sure. Well, I think it's a similar story here today with the equity markets. You've seen Canada push up against the dollar and push down below that 127 mark again. And it goes right along with what's happening with the euro dollar and the sterling dollar. It's that as equity markets push higher, rather than this whole theme of risk aversion that we've heard about for the past 6 months, it's possibly a switch to risk assumption. And so as that happens, obviously the commodity currencies will gain a little bit here.
Okay. So in terms of fundamental data right now, what's your what's next on your horizon in a major fundamental release in U.S., Europe, and Asia? What are you looking ahead for?
Well, I think the most important piece of information we're going to see this week is actually the Fed's rate decision tomorrow. Obviously, with the U.S. rates sitting at 0% to 0.25%, we're not expecting a cut, a hike, or anything along those lines. But what would be interesting is if they give any sort of commentary outlining any type of plans to buy treasuries here in the near future, or the medium term, or the long term. It's been speculation. It's been on the table for the past few months here, but no specific details have been outlined as to when this might happen. That the Fed would actively buy long-term treasuries to effectively lower long-term interest rates. So if they do outline anything along those lines, I think it'll be very telling as to where the U.S. economy is going over the next 12 months and where the U.S. dollar will be going over the next 12 months.
Matt, you mentioned the buying treasuries, the Fed buying treasuries, and
right.
That's basically their mandate, and they've done everything but that in the past year. And so, do you see that as a distinct possibility? And if you do, what do you think the implications are?
I do. Considering exactly as you said, it is part of their mandate, and that's the one thing that they've obviously avoided over the past 12 months. It does seem like it is inevitable at some point, either this month, next month, or sometime in the next 6 months. And the implications of that, it's going to be interesting to see what happens. Obviously, it's going to be the Fed expanding its balance sheet on a massive level and potentially flooding the market with dollars. However, a little bit contradictory to that, we don't see dollar weakness for the next 12 months here. I think the dollar will continue to strengthen against most major currencies as the markets continue to reward central banks that are proactive in fighting the recession and are proactive in stimulating the economy. And so as the U.S. economy emerges from this current downturn, the U.S. dollar will continue to strengthen.
Okay, Matt, we're going to leave it there for today. Thanks for joining us today.
Thank you very much for having me.
This has been your New York Forex Market Buzz with Matt Esteve of Tempus Consulting. I'm Tim Kelly. Join us later this afternoon for PM Exchange right here on ForexTV.com.